Hello and welcome to an FX Times weekly Forex news recap. I'm Nick Nassad, Chief Market Analyst here at FXTimes.com. Today is Friday, December 10th. To end this week's trading, we saw the US dollar gaining following a blowout US trade report. It begs the question, is the US recovery for real? Overnight, the US dollar was softer as yields had fallen to end Thursday's US trading session after we had a 30-year auction of US Treasuries see some pretty good demand. The main stories overnight was a positive Chinese trade balance report, but also another 50 basis point bump up by China's central bank of the country's bank reserve requirement ratio. It's the third time they've done this in the last month, and the rate is now at 18.5%. This is an attempt by Chinese officials to mop up excess liquidity within their financial system. In Europe, there has been little headway in terms of crafting a long-term solution for the sovereign debt crisis, and Eurozone periphery country yield spreads compared to Germany rose yet again, which pressured the euro. Coming into the New York trading session, the USD was soft therefore, but ready to gain if the trade balance report came in better than expected, and did it. It was the best figure since January as exports rose to a 2-year high. Also, we had a second report showing US consumer confidence increased in December. The trade data is a positive for US growth, and it helped to increase demand for the US dollar on a US recovery story. Let's take a look at that trade data a little bit more closely. The US trade deficit shrank more than forecast as we had a weaker dollar and strong demand from emerging markets. As I mentioned, exports hit a 2-year high, and exports to China and Mexico were at record levels. Overall, the trade gap totaled $38.7 billion, and that was lower than the lowest estimate of 78 economists surveyed by Bloomberg, so it shows you how big of a surprise this reading really was. The trade deficit shrank 13.2% compared to September. We had exports rising 3.2%, while imports declined 0.5%. This report is important because trade has been a strong net negative on U.S. growth. Trade chopped off a whopping 3.5% out of growth in the second quarter and was a 1.8% drag in the third quarter. TD Securities and others revised up their forecasts for U.S. GDP in the fourth quarter following the report. They say that the GDP will rise 2.6% compared with their previous forecast of 2.1%. So even if trade is not a net positive in the fourth quarter, it will at least not take off nearly as much growth as it did earlier in the year. Speaking of trade data, I did mention China's trade balance, which came in better than expected as well. The surplus there for November stood at $22.9 billion, shrinking from $27.1 billion in October, but coming in above the $22.3 billion surplus expected. Exports jumped 34.9% in November from a year ago. That was higher than the pace in October and much higher than the 22.4% increase expected, and it's a very strong signal for the global recovery. But also, imports grew at an even faster pace than exports, climbing 37.7%, ahead of October's 25.3% increase and expectations of a 24.5% expansion. So that shows us that China is starting to consume more, some of that badly needed global rebalancing we had talked a lot about during the G20 meetings about a month ago. Over the weekend, we also get plenty of Chinese data, including an important inflation report. There is also always the chance that the central bank could raise interest rates over the weekend as well, so it's important to gauge what happens with the news there over the weekend. If we come back to the US, we also had a gauge of US consumer sentiment rise to 74.2 in early December, the preliminary reading from 71.6 in November. This is the UMich consumer sentiment. Despite the gains though, the gauge is still below pre-recession levels of more than 80, but it's a sign of an improving economy, and we can see that it's the best reading we've had in about 6 months. Now, a third report in the US showed import prices climbing higher than expected. That could raise some concerns about inflation. Month over month for November, import prices were up 1.3%, and in annual terms they were higher. They were 3.7% higher, which matches pretty much what we had in October. Alright, so let's bring all of that together and take a look at the US economy and the recent US dollar strength, and ask the question, are there some reasons to like the US dollar? We have been seeing better data, higher yields, and it could benefit from some defensive safety buying vis-a-vis China. The recent stream of US data has been positive, consumer spending numbers have been pretty robust, and today we saw consumer confidence rising. The ISM manufacturing report for November showed that the sector is expanding. We now see that exports hit a 2-year high. Also, falling jobless claims should tell us that the labor market is in a better state than the clunker of a number we saw in the November non-farm payroll report, our monthly US jobs report. With the announcement of an extension of tax cuts in addition to stimulus measures such as increasing unemployment benefits and credits for companies to invest and other stimulative tax credits, that could help add an extra point perhaps to U.S. growth and is a positive for the first quarter and the second quarter of 2011. If exports remain strong and trade stops being such a major drag on the economy, then we could see the recovery gaining momentum during those first 2 quarters of next year. A stronger recovery would ease the pressure on the Fed to keep loosening monetary policy, with some quarters already talking about possible quantitative easing 3. That has been pressuring the US dollar, and of course Bernanke himself mentioned the possibility of more bond purchases than the $600 billion already allocated for quantitative easing 2 when he had an interview with 60 Minutes this past Sunday. So the important thing for the US dollar is which story dominates, a recovery in the US or looser. So what's important for us is which story dominates, and that will determine how the US dollar moves. Is it that the US economic recovery is gaining momentum, or that the Fed is pursuing looser monetary policy? These two go together, and that a stronger economy means the Fed can perhaps stop at the $600 billion they already allocated for quantitative easing too. Let's go ahead and take a look at some currency pairs, starting with the euro dollar. We see that it traded mainly sideways during the overnight trading session, and we fell down to below the 1.32 level in the wake of the trade balance and then in the consumer confidence report. However, we see that fairly soon after the consumer confidence report, we moved back above the 1.32 level. We retraced a pretty good deal of the USD gains, and we ended around the middle of our trading session around our 200 period moving average. And for the week overall, we see that the euro US dollar has moved in favor of the dollar after hitting 1.34. We'll see if this 1.32 level now begins to set up as an important support level going forward. Taking a look at the dollar-yen pair, we see that on Monday and Tuesday, this pair surged about 200 pips higher from its support at 82.30, reaching a high of 84.40, which was our resistance from last week as well. Since hitting that high we see that the pair retraced its steps, falling down to its 38.2% Fibonacci retracement level at around 84.40. That also coincided with our moving averages. Today, in the wake of the US trade balance report, we saw the dollar-yen pair rallying all the way to 84 and stall out there. The story this week for the dollar-yen has been US Treasury yields. Yields, which had surged earlier in the week, consolidated following some auctions by the Fed of 10-year and 30-year notes and bonds, and yields rose again today as the prospect of a stronger US economy lessened demand for the safety of US Treasuries. November overall has seen a broad sell-off in US Treasuries, and we know that prices and yields move inversely of each other, that is, bond prices and bond yields. So as traders and investors are selling US bonds, yields have been rising, and that has been a major factor for the dollar-yen pair. Will US yields continue to climb? If so, the dollar-yen will rally. If not, we may continue to consolidate between this 84.40 level as our high and 82.80 and 82.20 as our supports. The pound dollar has had a pretty strong week, unlike the euro dollar, and is actually showing a rising channel. Today, after hitting a high near 1.58 overnight, about the top of that new channel resistance, we fell back in the wake of the US trade balance data, falling down to around 1.5750. And that's where we found support. From there, like the euro dollar, the greenback gave up a good chunk of its gains from that trade balance and consumer confidence group, and we traded around the middle of our day's range. UK data has been better than expected as well, so it has been performing better than the euro. Looking at one of our commodity currencies, the Aussie US dollar, not that interesting today. We rallied overnight, likely on the back of the China trade balance data, but after hitting a high just below 0.99, we leveled off in the wake of the US trade report. Overall, a pretty tight range in today's trading. But we did see the very strong employment report from Australia in yesterday's global trading session, so this pair seems to have recovered following its slide in the beginning of the week. That'll be all the pairs that I look at in this Friday video, but please do check out the rest of our videos on fxtimes.com or on our YouTube channel. I'll be adding an annotation to today's technical video update from our Chief Technical Strategist Fan Yang if you're watching this on YouTube. And so that will wrap up my coverage of the Forex market for this week, but make sure to tune in next week for your daily dose of the Forex news recap. You can find me on fxtimes.com and on our FX Times YouTube channel. At fxtimes.com, you'll also find other news, videos, analysis, and live events, all having to do with the Forex market. So, till next week, thank you for watching and have a great weekend.